Do you feel like it's time to change up your real estate portfolio as your life situation changes, but you don't know how exactly to go about? Changes in your life, like changing goals, constraints, and your financial situation, will likely mean that you will have to change up your real estate portfolio. And in my last video, I started a 3-part series that focused on how to help young investors get started sooner with real estate. And now let's move up the timeline. In this video, we'll talk about what changes need to be made to your real estate portfolio as you move from the first stage to the next stage in your life as you continue to grow your career and as your family size starts to expand. If you like content like this, please give us a thumbs up and don't forget to subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. To kick things off, let's see how life might look like in the starting part of the second stage in life. You might have started real estate investing a handful of years ago, and right now you're well leveraged with a loan-to-value ratio of 80% in your real estate portfolio. In this situation, if your money is in your principal residence, then you're generating around an 8% ROI annually, as we discussed in the last video. Condo investments generate around 19% ROI, and house investments generate the best ROI at 25%. And now things are changing. You've progressed in your career, so now you have a better salary and more investment income, which means you can qualify for bigger mortgages. You also have more savings, which means you will have more money to invest as well. But perhaps the biggest difference is that your family size is growing, so you'll need a bigger house in a family-friendly neighborhood. And at the same time, you will have less time to put into your real estate investments moving forward because of your family. So now you'll be shifting towards investing in more turnkey properties moving forward. What you should note here is that because you're less focused on value-add opportunities, finding properties with the best and most stable appreciation becomes increasingly important when it comes to refinancing for growth. You'll want the best appreciation so that you can pull money out more quickly, and you'll want more stable markets so that you'll be able to pull money out to reinvest whenever you're ready, compared to markets that have higher fluctuations in price, which means a bigger degree of refinancing uncertainty. Now, even with the changes in this stage in life, your overarching goal is probably still more or less the same. You still want to continue to grow your wealth, and because you've been investing in real estate for a few years now, you might already have a general idea of what you should be investing in. But what's probably less clear is how exactly you should be changing up your portfolio given this new stage in life. Should you sell some of your existing investments to buy a bigger home, or is there a better way to do things? Now, there's a lot of possibilities here, so perhaps the best way to explore the answer is by walking through a couple of examples. For our first example, we have house hackers who bought an $800,000 house a couple of years ago, and it's now worth $1 million. They've been living in the basement, which is a third of the house, and they've been renting the rest of it out. Rental properties have higher ROI at around 25%, whereas a principal residence has an ROI of 8%, so their combined ROI is around 19%. Now they need more space for a growing family. An easy way to do this, if they're still okay with living with tenants, is to switch things up. Instead of living in the basement, they can take over the main and second floor of the house and then rent out the basement instead. So the investment percentage will change from 2/3 to 1/3, and their ROI will now drop to 14%. There can be a better way to do things if they have extra savings of around $100,000 to buy a second house and get more privacy at the same time. What will happen is that they can refinance their current house to take out an extra $160,000 and then add that to their extra savings of $100,000. Now, a combined $260,000 will give them enough capital to buy a second house that's worth around $1 million. And now we have one house that's completely a rental property and a second house that's completely a principal residence. And so our investment percentage goes from 2/3 to a half, or a weighted average ROI of 16.5%. Note that besides getting a bigger ROI versus just taking over the upper part of the house, they also have more capital parked in real estate now, so now they're able to achieve better absolute returns as well. Next, let's look at example 2, where we have condo owners who have two similar priced $500,000 condos. One condo investment plus a second condo that's their principal residence. Condos have lower rent yields, so at the current moment, they have a weighted average ROI of 13.5%. If they have enough from refinancing plus savings to buy a new house, that's always the best choice for growth because they can save on transaction fees and possible taxes. But let's see what happens if the condo owners don't have enough capital to refinance and grow. In this case, they will have to sell their condo home in order to buy their bigger $1 million house for their principal residence. This means their investment percentage would go from 1/2 to 1/3, taking their new ROI to 11.7%. On top of this, they also have to pay selling fees of around 5% of the condo selling price. In other words, if their long-term goal is to maximize returns, house hacking would have been the better option to start with. The current stage in life stretches for the longest period of time, and as you move along, you'll find that your investment as a percentage of your total real estate portfolio will start to zigzag. In the beginning, your investment percentage might drop as you grow your principal residence. But because the investment ROI grows at a quicker pace compared to your principal residence, your investment percentage will start to catch up again. Later on, you might decide to improve your principal residence and buy that better forever home, which means your investment percentage will go down once again. And finally, after you purchase your forever home, your investment percentage will start going up more permanently until you approach the next stage in life where you start planning for retirement. Even if you're not in the retirement stage yet, I think it's a good idea to get more clarity on the whole real estate investing roadmap, which can help you make better investment decisions along the way. For example, if you knew what's to come a few years down the road, a condo investor may have gone with house hacking instead, which generates better total ROI in the long run. So, if you're looking to complete your real estate investing roadmap, please stay tuned for next week's video for the final one in the series. If you're at a point where you need or want to change up your portfolio, but you don't know how to go about, our Elevate team is here to help. We're a real estate brokerage that specializes in real estate investments in Toronto, and when you work with us, we'll take the time to review your existing portfolio, make our best recommendations, and then help you grow your real estate portfolio and align it better to your goals. We offer end-to-end services because we know some of you might be strapped for time. So besides real estate sales, we'll also connect you with our reliable contractors, help with leasing and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you do want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.